What is happening, crypto fam, and welcome back to Bitcoin Bulletin, your ultimate source for the pulse of the digital asset world. The news cycle is absolutely on fire, and we've got a packed show today with updates that you simply cannot afford to miss. Get ready, because we're diving headfirst into a rapidly evolving market where strategic moves and regulatory shifts are making waves. From massive corporate treasury plays that are redefining how companies view digital assets, to critical developments that could reshape the future of major altcoins, and even the intricate dance of international regulatory policy, we're covering it all. This is your front row seat to the stories that matter, delivered with the energy you expect. So strap in, stay sharp, and let's get straight into the action. First up, we're breaking down a monumental $5 billion Bitcoin play from a major NASDAQ-listed firm, a move that's sending shockwaves through the market and raising some serious questions about altcoin liquidity. Is this the future of corporate treasury or a sign of deeper market shifts? You need to know this. Then, we're shifting gears to explore how regulatory clarity and key integrations could be the game changer for Cardano's ADA token, with insights from Charles Hoskinson himself. What does this mean for the broader altcoin landscape? You won't want to miss this analysis. After that, we're heading south to Brazil, where the central bank is facing intense criticism over its stance on Bitcoin reserves. This policy debate could have massive implications for crypto adoption in Latin America. We'll get into the details of why this matters. And finally, we're looking at the structural bull case for Bitcoin itself, especially as Ethereum faces its own set of challenges. Is Bitcoin solidifying its dominance? We've got the breakdown. You absolutely need to stay informed, so make sure you're hitting that like button, subscribing to the channel, and ringing that notification bell so you never miss an update. Let's go. A $5 billion Bitcoin bet, corporate treasury redefined. In a move that's sending ripples across the financial world, NASDAQ-listed healthcare firm, Kindly, MD, has announced a staggering $5 billion automatic shelf registration statement with the SEC. This filing comes hot on the heels of their massive $679 million Bitcoin purchase last week, signaling a bold new era for corporate treasury strategies. Kindly, MD has officially declared Bitcoin as its primary treasury reserve asset, with a clear focus on accumulating a long-term position. This strategic pivot not only establishes them as a well-known seasoned issuer, granting them greater flexibility in capital markets, but also authorizes a diverse range of financial instruments for distribution, backed by prominent underwriters like Cantor Fitzgerald and TD Securities in the US and Canaccord Genuity in Canada. The company's subsidiary, Nakamoto Holdings, spearheaded the recent Bitcoin acquisition, reinforcing Kindly MD's conviction in Bitcoin as the ultimate reserve asset for corporations and institutions. Analysts like Jay Zhou from Tiger Research note that while this WKSI status provides a significant advantage in capital raising, it also brings substantial pressure due to large issuance volumes and high market volatility risks. Kelvin Ko, co-founder and CIO at Spartan Group, observes that institutional crypto exposure has seamlessly integrated into corporate balance sheets and treasury strategies, a trend accelerated by the 2024 U.S. Bitcoin ETF approvals and aligned with pro-crypto policies. This has, in turn, normalized crypto exposure and paved the way for altcoin-focused digital asset treasuries. However, Ko also raises a critical point about the broader market implications of this trend. He suggests that the continued accumulation and expansion of digital asset treasuries, DATs, might come at the expense of the wider altcoin market liquidity. Initially, DATs were almost exclusively Bitcoin-focused, leveraging Bitcoin's narrative as a scarce, non-sovereign store of value. The model, as outlined in Ko's research, relies heavily on equity raises to purchase crypto, making these entities highly susceptible to volatility. A sharp downturn could potentially cut off new capital, forcing asset sales that could amplify market declines. When hundreds of firms pursue the same strategy, the market structure becomes fragile, Ko warns. The implications for the broader altcoin ecosystem remain a key point of discussion as these large-scale corporate strategies unfold. But what happens when these massive corporate plays start to impact the very ecosystem they're investing in? We'll delve into the potential consequences for altcoin liquidity right after this. Cardano's ADA, navigating regulatory wins and Bitcoin integration. Cardano's native token, ADA, is currently trading around the 87 cents mark, experiencing a modest 3% dip amidst broader macroeconomic uncertainty and evolving regulatory landscapes. The recent performance of ADA is being closely watched, especially in light of potential shifts influenced by developments like the Digital Asset Market Clarity Act and expectations surrounding Federal Reserve interest rate decisions. Despite short-term volatility, which saw ADA swing over 10% in a single session, the token is showing signs of stabilization near key support levels, with buyers stepping in at higher volumes around the 0.856 mark. Charles Hoskinson, a pivotal figure in the Cardano ecosystem, recently shared insights during an AMA session, highlighting two key catalysts poised to drive the next phase of growth for ADA. Firstly, the development of the Midnight Network is expected to significantly enhance data privacy on the Cardano platform, potentially unlocking new use cases and attracting a wider range of applications. Secondly, and perhaps more significantly for the broader market, Hoskinson emphasized the potential impact of Bitcoin integration. This strategic move could bridge Cardano with the largest digital asset, potentially increasing its utility and appeal to both institutional and retail investors. These developments are complemented by substantial financial backing. A $23 million investment has been allocated to bolster Cardano native tokens, aiming to inject fresh capital into promising projects within the ecosystem and support developer initiatives. This funding is crucial for strengthening Cardano's competitive position and fostering innovation across its diverse token landscape. Furthermore, strategic partnerships are being forged to enhance ADA's accessibility and visibility on a global scale. A notable collaboration with Copper, a leading digital asset custodian, is set to expand Cardano's access to major exchanges. Coupled with prior integrations with platforms like Blockchain.com, these efforts are designed to onboard Cardano onto more than 37 million users, significantly boosting its market presence. While ADA has seen a remarkable 125% increase over the past year, it still operates below its all-time high of $2.90 from August 2021. The broader crypto market, as indicated by the CoinDesk 20 index, has also seen a decline of over 3%, suggesting a period of market consolidation. Analysts are keenly observing upcoming economic indicators, particularly the Federal Reserve's potential rate cut in September, which could catalyze broader market momentum. Cardano's strategic focus on privacy through the Midnight Network, its integration plans with Bitcoin, and its expanding network of partnerships position it strongly for future growth and adoption. As the market landscape continues to evolve, ADA's ability to leverage these initiatives will be key to its sustained performance and market penetration. But how does this regulatory clarity in one corner of the crypto world contrast with the policy debates happening elsewhere? We'll explore the critical stance of Brazil's central bank on Bitcoin reserves next. Brazil's central bank stumbles on Bitcoin reserves, a policy crossroads. Brazil's central bank is facing significant criticism for its hesitant and inconsistent approach to Bitcoin reserve policies, according to a recent report from LATAM Insights. The bank has reportedly rejected a proposal that would have allowed up to 5% of the nation's foreign reserves to be allocated to Bitcoin, a move that could have positioned Brazil as a leader in Latin America's burgeoning crypto landscape. During a congressional hearing, a representative from the central bank characterized Bitcoin as a capital instrument rather than a reserve asset, citing concerns about increased financial risks associated with its inclusion in the reserve portfolio. This stance contrasts sharply with the growing global trend of major economies and corporations considering or actively incorporating Bitcoin into their treasury strategies as a hedge against inflation and a store of value. Analysts suggest that this reluctance by the Central Bank of Brazil could impede the development of a clear digital asset policy for the country, potentially dampening both domestic and international investor confidence. The report also warns that the central bank's position might influence legislative decisions, potentially delaying crucial bills aimed at fostering innovation and diversification within the financial sector. Despite these internal challenges, there remains optimism that informed legislators can champion initiatives that recognize Bitcoin's unique properties. Such forward-thinking policies could not only bolster Brazil's financial resilience, but also solidify its regional leadership in cryptocurrency adoption. However, without a strong political will to counter the central bank's current reservations, Brazil risks being outpaced by other nations actively integrating digital assets into their financial frameworks. CoinGecko and CoinRank have both highlighted the necessity for structured digital asset strategies, especially in regions like Latin America, where cryptocurrency adoption is rapidly accelerating, often outpacing regulatory frameworks. The current debate places Brazil at a critical juncture in its financial policy evolution. The central bank's cautious approach raises pertinent questions about its readiness to embrace digital assets and its capacity to support a modern, adaptable financial system. Market observers are keenly awaiting the outcome of these policy discussions, particularly whether policymakers will challenge the central bank's conservative stance and advance initiatives that could unlock significant economic potential through digital asset integration. With such significant policy decisions being debated globally, where does that leave the undisputed king of crypto in its own market structure? We're examining Bitcoin's path to dominance and the structural bull case for BTC next. Bitcoin's ascendancy, a structural bull case amidst Ethereum's shifting tides. As the cryptocurrency market continues its complex evolution, Bitcoin is increasingly solidifying its position as the dominant digital asset, bolstered by a robust structural bull case. This narrative gains further traction when viewed against the backdrop of challenges and shifts occurring within other major cryptocurrencies, most notably Ethereum. While the specifics of Ethereum's recent performance and underlying market dynamics are subject to ongoing analysis, the broader trend suggests a potential divergence in market sentiment and structural appeal between the two leading digital assets. The structural bull case for Bitcoin is underpinned by several key factors that differentiate it from many altcoins. Its role as a primary store of value, often compared to digital gold, continues to resonate with institutional investors and corporations seeking to diversify their treasury reserves. The increasing adoption of Bitcoin as a legal tender in some jurisdictions, coupled with the approval of Bitcoin spot ETFs in major markets like the United States, has significantly enhanced its accessibility and legitimacy. These developments have not only driven significant capital inflows, but have also normalized Bitcoin's presence within traditional financial ecosystems. Furthermore, Bitcoin's fixed supply cap of 21 million coins inherently creates scarcity, a fundamental driver of its value proposition. This predictable monetary policy, contrasted with the often more fluid tokenomics of other digital assets, provides a level of certainty that appeals to long-term investors. The network's security, maintained through a robust proof-of-work consensus mechanism and immense computational power, also contributes to its resilience and perceived safety, especially during periods of market stress. In contrast, while Ethereum remains a foundational platform for decentralized finance, DeFi, and non-fungible tokens, NFTs, it faces its own set of challenges and competitive pressures. Ongoing debates about its network upgrades, scalability solutions, and the evolving landscape of smart contract platforms mean that its structural narrative is subject to more frequent recalibration. The potential for increased competition from newer, more efficient blockchain technologies, as well as regulatory uncertainties surrounding its classification and utility, adds layers of complexity to its long-term outlook. The divergence in these narratives creates a compelling environment for Bitcoin's continued dominance. As institutional capital flows increasingly favor assets with clear, established value propositions and robust market infrastructure, Bitcoin appears well-positioned to capture a larger share of the digital asset market. The ongoing development of the Bitcoin ecosystem, including advancements in Layer 2 solutions that enhance scalability and transaction efficiency, further strengthens its fundamental appeal. This structural advantage, combined with its established brand recognition and market leadership, paints a picture of sustained growth and increasing influence for Bitcoin in the years to come. So, with all these major shifts happening, what are the key takeaways from today's massive updates? We'll wrap it all up with a lightning round recap right after this. And that's a wrap on another action-packed episode of Bitcoin Bulletin. We covered a massive $5 billion Bitcoin play by Kindly MD, potentially reshaping corporate treasuries. We explored how Cardano's ADA could be boosted by regulatory clarity and Bitcoin integration. We saw Brazil's central bank facing criticism for its Bitcoin reserve policy stance. And we analyzed Bitcoin's strong structural case for dominance amidst other market shifts. Don't miss out on any of these critical developments. Hit that like button, subscribe to Bitcoin Bulletin, ring the notification bell, and follow us on all social platforms to stay ahead of the curve. We'll see you in the next one.